start at a higher level. Two primary structures: venture capital, private equity. VC funds target early stage, high growth companies within high growth sectors such as technology. So higher risk, higher potential reward. Private equity funds invest in established companies and proven market sectors, meaning they're more predictable and usually more defensive. Regardless of which one you choose, all must be CMVM regulated. Now, here is where it gets more interesting, especially for American clients who are financially savvy. Most have portfolios heavy weighted toward ETFs, index funds, and individual stocks, or a portfolio of stocks back home, often with significant tech exposure. Now, that served them well, and it has also served me well, quite frankly. But this also means concentration risk. Tech has had an extraordinary run, but many analysts, and I think we can all agree, we can expect a correction at some point, and when it comes, that exposure will hurt. The Portuguese Golden Visa offers genuine diversification, not just geographic, but sector-wise as well. Within private equity, which is where most of our clients invest, you'll find that funds are covering basically some 6 sectors in general. And these 6 sectors also correspond to industry sectors that are profitable and growing. And I'll give you examples of some of those sectors. Hospitality and tourism. Portugal was named Europe's leading destination at the World Travel Awards in 2024 and has won multitude of awards. The sector contributes around 16% of the GDP and continues to grow year after year. Another sector, clean and renewable energy. Portugal is targeting a 5-fold increase of solar capacity by 2030. And the country is on track for 85 to 93% of renewable electricity by the end of this decade. Next sector, education. Most international schools operate with wait lists and charge 15,000 to 30,000 per year. Parents don't pull their children out of school during economic downturn. This is a very defensive sector. Next, retail, meaning funds investing in operating companies that have prime locations, for example, supermarkets. This is also a sector that's resilient even during economic turbulence. Another sector that's of interest, agro-forestry. Portugal exports and produces over 50% of the world's cork. The EU alone has allocated over 6.5 billion to Portuguese agriculture between 2023 to 2027 to support modernization and sustainable practices. One more sector of interest, financial markets, meaning bonds, equities, short-term deposits. And this typically is the most defensive option out there and is diversified across assets both domestically and internationally. So in conclusion, what we like to say to our clients is that by investing in the Golden Visa, not only you're investing due to that option or plan B, if you will, you're also moving your capital into defensive European sectors, reducing your reliance on US and potentially US tech, and building a truly diversified portfolio across continents. We typically tell our clients to imagine an equation with many variables. Why? Because we cannot assess a fund solely on one variable, but within the context of all of them, right? So with our clients, what we do is we place different weights on those variables based on their profile to help them crystallize their priorities. And something that we never forget is how many years does the client have before the retirement age, as that will directly influence the typology of funds they should consider. So here are some of the variables that we take into account. First, manager's track record, an obvious one, right? So the fund manager must have performance and history, ideally, that predates Golden Visa. So what we see in the market sometimes are these first-time managers that do carry higher risk, right? Second, clear investment strategy. So we need specifics, what sectors, what company stages, what geographies, what exit timeline. Vague strategies are potentially a red flag. Third, transparent fee structure, meaning overly expensive fee structure is reason enough to walk away. Next, and fourth, for USA investors specifically, the fund must provide PFIC annual information statements. Without this, you face punitive IRS taxation that can erode your entire return, and this is a non-negotiable. Fifth, independent oversight. So ideally, we're talking here about the big four auditing firms or another big company out there that basically protects you from inflated reporting. Sixth, we speak directly with previous fund investors, not just references that the manager provides. So we ask, how did the fund perform? Did it perform as projected? Was communication transparent and timely? Would you invest again? Now, beyond the checklist, there's something harder to quantify. The fact is, we've been in the market for nearly 7 years. We know these fund managers. We know how fast they reply to emails. We know who's professional and who's disorganized. We know who's hungry and building something versus just collecting management fees. Now, these are subjective signals, fair, true, but after hundreds of clients' engagements, they do matter. They tell you who will actually fight for your returns. Now, a bonus, if we can find it, are managers who invest their own capital alongside yours. That's basically skin in the game. It's rare, not a necessity, but it's a nice to have. So basically miss these and a few other criteria and you're taking unnecessary risk with your 500,000. Yes, once you have permanent residency, you are free to liquidate. But here's the reality. Fund investment cycles typically run 6, 7, 10 years. So even though your residency requirement is met at year 5, your capital may remain invested until the fund naturally exits its position. This is normal for private equity structure. It's not related to Golden Visa limitation. It's just how private equity works. So you need to plan that liquidity timeline from the start. A very good question, and I would potentially mention 3 major ones. First, funds and fund managers created purely to capture Golden Visa capital. And you'll see managers with very little experience in actual fund management who appear specifically to tap into this investor pool. So no prior track record, no successful exits, no history of returning capital to investors. And that's a red flag. Second, the difference between raising capital and deploying capital is big. Some fund managers are excellent marketeers. Beautiful websites, polished presentations, they're great at getting you to sign up. But raising capital, meaning money, and investing it intelligently are 2 different skills. If the capital sits idle or gets deployed poorly, you won't see the returns, right? So we look for managers who have solid nationwide network so they can deploy the capital. We're looking for fund managers with proven ability to source deals, execute investments, and create value, not just close subscriptions. Third, funds claiming to be non-real estate, but investing in companies whose only assets are residential properties. Now, that may technically comply with the letter of the 2023 law, but it violates the spirit. So we don't want you to be caught in this gray zone. So basically, the common thread that I was just mentioning is do your due diligence on the manager, not just the fund.